Hey people, thank you for stopping by Building Wealth with Rajiv. If you're looking to buy another book on value investing, don't. Please listen to this chat with Professor Bakshi instead. Professor Sanjay Bakshi is a distinguished professor of behavioral finance and value investing at Flame University in India. He's an investor himself and a world-class educator. Professor Bakshi and me chat about a couple of things: what makes a great investment, what makes a great company, valuations, and more importantly, how to become a great investor. Hopefully, you like this chat. For such meaningful discussions, please follow my channel. I'm on Spotify, Apple, and Google as well. Now, for this chat particularly, please use your headphones. Professor Bakshi, namaskar. Thank you so much for joining.
Rajiv.
It's an honor. And 1 year wait with chatting with you, but all worth it.
Yeah.
Okay, so I think as I said that Professor Bakshi heard on various podcasts, YouTube channels. My thing is, getting some inspiration for people like me, or or even your peers, on the investing process, your thinking, how you evolved as it. Tell me, I think let's start with how you started as investing. What got you in?
What got me into investing? I mean, it's just something. My dad was an investor. He used to invest in a lot of Indian companies and he used to talk about stocks, and I was fascinated by that. I did my CA from India in Pricewaterhouse. So over there, I learned about how accounting works. How transactions become financial statements, how auditing happens, how there is a lot of ambiguity between what a business earns and what a business says it earns. So all those things were sort of learned while I was studying accounting and auditing at Pricewaterhouse at the time. Then I got a chance to go to England to study at the London School of Economics, and that's there when I got the value investing bug. Basically, came across accidentally an article on Warren Buffett. And he was this is 1990. He wasn't as well known as he is right now, and he basically said a few things that caught my attention. One was that markets are often inefficient, which was the exact opposite of what I was being taught at the LSE. So I had the immediate episode of cognitive dissonance. And the other thing the article said was, here is a guy who stays far away from Wall Street, and he thinks the markets are often quite inefficient, and he has a wonderful track record. And it also says that he writes wonderful letters, and that you don't need to have the money to buy the shares of his company to get the letters. So I didn't have any money at the time, anyways. So I wrote to him and its office, and they sent me the letters. And then I found my calling, basically. And anybody who reads those letters at a young age, who's trying to look for something to do in life and has a general interest in finance and investing, would obviously find that very, very inspirational. So that's what happened to me. And through his letters, I found Ben Graham, his own teacher, and through those the writings of Ben Graham, I picked up all the books that he had written and worked through the examples. The good thing about Graham books is that his examples change over time. All the editions are different of security analysis, and his own thinking changed over time. And you can work through the examples, and they're all very accounting sort of. Anybody who's an accountant can understand those examples very well because he's talking about working capital and he's talking about cash and he's talking about dividends. He's talking about basic fundamental factors. So he sort of completed the gap. So while at Pricewaterhouse and my career as a accountant, I knew about how accounting works, but I had no idea about valuation or what is cheap and what is expensive. So that Graham taught me. Buffett letters obviously told you a lot more about business economics because subsequent to, I mean, in his later years, he transitioned into being a quality investor. So he started focusing a lot more on business economics and management qualities and competitive advantage and so many other things, which are pretty much absent in Graham's books.
Yeah.
And he talks a lot about psychology also, business psychology, investor psychology. So you could connect a lot of dots, fill gaps in my education. And yeah, this is how it started. And once it starts, then it's not easy to. It's
No,
still
it's
going on. It's
addictive.
still going on.
It's addictive, sir. I mean, it's, when I'm just started just some time ago, and it's pretty addictive. So I think you covered quite a bit of ground. So Ben Graham's book, which book are you talking about, Professor
Security
Bakshi?
Analysis 34 was the first edition. My favorite edition is, I think, 51. That is the third edition.
Mm-hmm.
It is my favorite because it had an annexure called Special Situations. That's the only edition
Okay.
that has that annexure. And in that, he talked about how to think about events, uh, corporate events that can have a bearing on security valuations, things like
Mm-hmm.
mergers and acquisitions, things like recapitalization or bankruptcy workouts or stock buybacks or tender offers. So where you are basically betting on the happening or non-happening of a corporate event instead of betting on how the business will do over a period of time,
Okay.
which was very interesting to me because at the time, as I mentioned, I was an accountant. I had not yet discovered a lot of understanding of business economics from Warren Buffett. So I found that very analytical and very mathematical, and it gave me a worldview of how to think probabilistically, which is, I think, a very important skill to have.
Mm.
Even if you don't do special situation, you should practice it nevertheless, because it
Okay.
forces you to understand and to recognize that the world is a very probabilistic place. So he had a framework which is now we all know as a expected return framework.
Mm-hmm.
He worked out the probability of an event happening and what would be the consequences if it happened,
Mm-hmm.
and the probability of it not happening and what would be the consequences, and work out a expected return and then decide whether he wants to invest or not, and then that numbers will change. So a thing that was a buy at a given time could become a sell tomorrow because the price moved up and the expected return collapses. So it forces you to acknowledge that the world changes and sometimes the odds change. A deal that is likely to happen just fails. And of course, the expected return completely collapses because one part of the equation just goes away. So it forces you to do many things. One, recognize the world is a probabilistic place. To force you to think in terms of probabilities and assign subjective probabilities, which you will change as you gain experience. And finally, to acknowledge that as new information comes in, the odds change, and you have to factor that in your thinking. And that last part is so important in our own investment thinking, even if you don't do special situations, even if you don't do risk arbitrage, because that's all we do, right? We have an initial hypothesis, and there are always something new that is happening, which could be material, could be non-material, should either reinforce your prior beliefs, or maybe weaken them, or may have no influence on them, and that's clearly Bayesian reasoning. So Graham basically taught that in a very practical sense, and that's why the third edition is my favorite. So I picked that up, and I decided that this is what I want to do because
Awesome. I had absolutely no clue that he talked about special edition, special situations. So I think, and I've interviewed some people in India who are doing special situation investing, and they've been able to beat the index and the market. And consistency is the key. We'll see. Professor Bakshi, this is interesting. So there is a business economics part, there is a valuation part, yeah, and you merge that together. What is missing here to become a great investor?
I think it's about your psychological mindset. Everybody knows that to do well in value investing, you have to buy things when they're cheap and to sell them when they're not cheap. But and that formula is known to everybody. But when things are cheap, there is a lot of fear, and fear is contagious. So one gets affected by that, and you decide that I'll wait, and things are not good right now. And I think March 2020, for example. So to have that mindset that uh, that the fear is a sort of a friend of the value investor. It's fear which creates low prices in relation to fundamental values. And on the other hand, it is optimism and euphoric feelings of making a lot of money, easy money for many people, which creates hype in the markets and which creates speculative bubbles. So most of what you have to learn is not just the analytical skills. Of course, you need accounting. Accounting is very important because unless you can understand rudimentary accounting as to how the numbers are created, how to read financial statements, you have to have a way of figuring out how the numbers talk to you about the business. How the three key financial statements interact with each other and what message they are giving you and how they change over time, not just for a given period of time. The balance sheet is made as of a 31st March of a given financial year, and the P&L and the cash flow statements are for that accounting period, but they're just covering just 1 year period. But you have to see how the change is happening over a period of time. As Buffett once said that you should think of a business as a evolving movie, not as a still photograph. The balance sheet is the still photograph, and we all know that when we pose for photographs, we comb our hair and we shave and we look our best. And that's exactly what companies do when they drop the balance sheet. So, but if you view them over a period of time, you get a sense of what's happening and you start thinking about where is this headed, because that's the game. The game is not about what has already happened, but what the future is going to do to this business. So you need accounting, you need business economics, and you need psychology. And then you need the mindset of being an independent thinker. You need all those things, all the ingredients. So yeah.
Well, I think it's amazing. Now, I think let me just dissect it. As I said, that I just want to, and I'm already learning so much, Professor Bakshi. Thank you so much. Speculative time, and you know, how do you want to give any example of the speculative time where you thought it's a speculative time, and you're watching it from distance and saying, "Huh, what's happening, man?" What's that time like? Talk about any time period and what was going through in your head.
So we saw that in .com, 2000 technology bubble. We saw the same bubble, pop recently, similar periods. The actors change, the script doesn't change. And anybody who's a student of financial history, I mean, the fourth ingredient I would add in those things, one was accounting, one was business economics, one was psychology, and the fourth one that I would add is history, financial history, history of businesses and markets. You learn a lot about watching what has happened in the past, because human nature has not changed, and the same tendencies that exist in us right now have existed in our fathers and grandfathers and their fathers and their grandfathers, and going back 3, 4, 500 years ago. There are all these bubbles that have come and gone. So the script doesn't change, the actors change. So whether you look at the South Sea bubble, or you look at the speculative, mania, tulipomania, or you look at the dot-com bubble, or you look at the recent bubble, is the same. The pattern doesn't change, right? The actors change, the names of companies will change, but the behaviors are the same. How investment bankers behave, for example, I'm not blaming them. I mean, they are just self-interested people with in the incentives. How IPO, this was not the first time the IPOs have bombed,
Oh
right?
man, this was terrible.
So it is terrible, but a lot of people think, oh my God, this has happened. But if you don't study history, if you don't see that this is not something which is unique to this period, it happens over and over again. There are these patterns that play out. So you only have to pick up a few books, right, on financial history to get a sense of this is repeating. So absolutely, you need to have that sense of financial history to be able to see a pattern or connect the dots, to see. Basically, the idea here is that when you have that background of history in your head, all these models are in your head, then when you're seeing what you're seeing, you ask yourself, what does it remind me of? And why does it remind me of it? These two are very critical questions, because as you go through life, you're observing something, you keep asking yourself these questions. What does it remind you of? Because you're seeking patterns, you're trying to say similarities. What is this similar to? So you start connecting the dots with something that happened in the past in your own experience, for example, or in the experience of other human beings who have lived many generations before you, but have gone through the same sort of situations, and it's all sort of documented so well. So what does it remind me of, and why does it remind me of it? So you find causal reasons as to why is this happening. Why do IPO bubbles happen? There are so many causal factors, and one of them is uh, the investment bankers' behavior. But that's not the only one. There are many more things that contribute to that. But and those things will not change, because the if you indulge in this first principle thinking, you go down to the root cause of why these things happen. Why do we have bubbles? Why do we have busts? Why do we have speculative episodes? Why do we have bull market? Why do we have shortages? Why do we have gluts? All these are covered in economic book textbooks, without any regard of what is the psychological models which contribute to gluts or to shortages. So when you combine all these things, and combining the disciplines of psychology and accounting and economics gives you a better worldview than any one of those one fields will do. So that's why multidisciplinary mindset that Charlie Munger writes about is actually very important to imbibe and learn.
Amazing. Now, history, Professor Bakshi, interesting. Now, and a lot of my questions are inspired by my own experience, and I'm looking for a teacher all the time, a seeker. Tell me, history. I've started investing for 2 years. History is what? So, are you talking about I learn about price action? That is a technical analysis, which you know, which is bit of a, 200-day moving. It's like, or 5 years or whatever, 3 years time period, that kind of a price action it gives me, or is it the matter of my experience that I have to spend time in the market?
I think it's neither of this. For me, it's neither, because
Okay.
when I talk about history, I really mean about. See, I'm a fundamental investor. I don't want to pull down technical analysis. It's not my game. There
Okay.
are other people who do it very well. I don't understand it. I don't follow it. I'm only talking to you from the perspective of a fundamental investor.
Hmm.
So, here you're basically betting on how the business will do over the next, 5, 10 years or even more after you have bought it. And you want to have a sense of what causes business success and what causes business failure. You want to avoid patterns of business failure. You want to, imbibe or, find similarities between what you think is successful business and other similar successful business that have existed in the past, and that will help you, decide whether this is a good business to invest in or not. So for me, it's the history is about learning from extremes, extreme success and extreme failure, because all the learning is on both ends of the spectrum. In between, there's a lot of mediocrity. All the lessons. In fact, if you look at the recent, a lot of the people, I won't name names, but a lot of people have lost their companies because they had taken on too much debt, and the bankers
Hmm.
had sold those companies. So those are great teachers for me. In fact, I have a slide in my class where I put photographs of 12 such people, um, and these are well-known people, but at the time when they were doing very well, the media was calling them as heroes, and they were doing very well because leverage was working in their
Hmm.
favor.
Favor.
But when you are playing with leverage, you're like an accident waiting to happen. And accidents in the world of business and in investing almost always happen. So when they happen, then they've gone from heroes to zeros. Many of them have lost their company. Some of them have, health issues. Some of them have run away from the country because the lenders are chasing them. And so basically, these are all, people who are telling you, as Charlie Munger says, you don't have to pee on an electric fence to learn how to do it. So the kind of mistake that investors make, for example, not just business people, but also because you see, when you're investing, you're basically trying to ride on the coattails of people who are making operating and capital allocation decisions in various businesses. So you have to understand how they make mistakes. So you have to worry about two types of mistakes: mistakes that business people make, for that there is so much history of companies blowing up and why, and what are the causal factors, and number two, how you can make mistake, investors make mistake, how they get carried away, all the investor biases that exist from social psychology or behavioral finance. So it's important to have a sense of how to avoid mistakes, how to go away, run away from errors, or not to make the mistakes that other people have made. And that's important because you only have a limited life, and you can only learn so much by making your own mistakes, and you will learn from your own mistakes. I don't want to underplay the importance of learning from your own mistakes, but there are so many more mistakes made by other people in the past, both investors and business managers, that from an investment standpoint, it's a great idea to learn from their mistakes because the tuition fees is not there. But if you can empathize with the pain that they face and learn from that, it can give you a better sense. And of course, this body of experience is so much vaster. You live only 80, 100 years, but there's a body of experience going back 5, 7, 800 years of human folly. So you become a collector of human folly, including your own folly. So you will learn from your mistakes and you will learn from other people's mistakes. So I learned from extremes, and it's important to imbibe that. But here is the thing: one of the things that I've truly learned over the last few years is that there is a huge asymmetry between success and failure. There are many ways to succeed. People try all kinds of things, which everybody thinks is crazy, but they turn out to be enormously successful. But there are only a few ways to fail spectacularly. So the causal factors of failure are few and far between, but the causes for success are numerous.
Oh, that's great. That's a great point, sir.
So it makes a lot of sense to focus on human folly or causes of enormous failures, and try to avoid those things in yourself or in partnering with people who may be making those kind of mistakes. So avoiding dumb behavior, your own behavior and that of the people that you want to invest with, is, I think, easier than trying to figure out whether crypto is going to work or not, or whether which is the best company to own in logistics, or anything that is going through a period of rapid change. So there are many things that will work. It's hard to predict, but there are only few things that will fail, and they're easy to spot.
That's amazing. Now, What I just wanted to get your thing in the valuation. We talked about valuation. I'm just trying to slice your interview, Professor Bakshi, and I'm going to ask some questions later on, especially in investment bankers who've created a lot of problems for a lot of people. Now, valuation. What do you swear by?
So, a lot of people have all these metrics they use, and they are useful metrics, no doubt, things like multiples of, revenues or earnings or cash flows or dividend yields and book values and so on. And these are just, some ratios which are useful. But I think what you're really trying to do is to figure out that if you were to buy this business today at the current market cap, if you bought this business as a whole, will you do better than putting your money in a fixed deposit, basically? If you can be certain that you'll do way better than fixed deposit, or AAA bonds, let's use that as an anchor, then you are onto something. So instead of trying to find out that the market multiple is 27 and I'm buying this company at 22, therefore it is cheap, is not a good idea. But you have choices. You can put your money in a fixed income security without taking a lot of credit risk, and maybe a AAA bond fund, and get some return on that 6-7% today. Or you can put your money in a business. You can put the same $100 on a business. If you put the $100 in the bond, you will get $6 today and no more than that, because that's the bond yield, $6 or $7. But if you put that money in a business, and if you got to begin with $12 or $10, and that grows over time, then you know that your outcomes as a business person in the business are going to be better than if you were to think of bond as a business. So bond as a business is a very important mental construct, which is that there is this perpetuity which will never grow, and it is not, and it will not shrink either, and it is not at risk, and you can always have that available to you without much effort. But on the other hand, you're going to put some effort. You're going into a business of investing in businesses, and therefore you want to make sure that the outcome of the effort is worth it. And that's what the game is. So basically, you may think that, okay, I want to make sure that the price that I'm paying, or the earnings that I'm going to acquire at whatever price I'm paying, may not give me 6% on my cost right now, but they will give me 8% 1 year from now, and maybe 12% 3 years from now, and maybe 30% 5 years from now. That's something. And that kind of thinking allows you to pay up for quality, because the earning stream is growing very rapidly. But to lose sight of this mental construct leads you down a slippery slope. Then you start putting numbers on things that don't make any money and won't be making any money for a long, long time, simply because there is price action, or there is, other people are paying for it, or it's a fancy thing, or there's an IP bubble going on, and there are all these business models out there. So, at the end of the day, for a value investor, the anchor always has to be underlying earnings and cash flows on one end, and the market value of the business, and how much and how the relationship uh, compares with putting your money in a AAA bond deal. So that's my way of thinking about valuation. There are other ways, to be sure, but this is
Uh,
the way I think about
no, no,
it.
I think that there are several. I think everything what you're saying, Professor Bakshi, it kind of lights up many more questions in our mind. But I'll just choose my battles here because the time is limited. Now, first thing is that you're a professor, sir. I mean, distinguished professor, and now I think model is part of that. I'm not sure like how so how do you like what do you tell students about it, like valuation? Is that from a teacher perspective, do you feel any paradox, kind of a contradictions or somewhere some hesitation or?
Not really. I mean, I teach two papers basically at Flame University. I teach a paper on behavioral economics, which basically combines the fields of economics and psychology. Economics, as you know, basically the
Mm,
traditional economic theories assume that people are rational.
mm,
Psychology, on the other hand, tells us that that's not always the case. So, by taking the models from both these disciplines and then combining them with real world experience in business and in investing, I hopefully show them how to accumulate sort of wisdom in a practical manner. So, that's one part. The other paper I teach is a paper on case studies in business and investment analysis, which is totally practical, case based, which
okay.
again focuses on successes and failures, both in the field of business and in the field of investing. That's why it's titled Case Studies in Business and Investment Analysis. So, what are the reasons why businesses fail or succeed? That's one part of it. The other is, why do investors go wrong? How do they go wrong? And how do they go absolutely right? So, those things, these two subjects taken together, papers that I teach taken together, hopefully are my contribution as a professor to the field that I come from. And I do think that students appreciate that.
Okay, so amazing. So it's good because I kind of was not aware of the exact disciplines. I thought you'd probably, like the textbook, but it seems that
No, no,
that's not
no,
the
it's
case.
not.
Okay,
I
all right.
actually don't prescribe any textbook. I
Okay,
hand out enormous amounts of materials to students to read from various letters and things that I've liked over the years, tweets that
okay.
I've accumulated. So I keep on, have a whole library of things that have inspired me, and that library keeps going year after year. It
Hmm.
comes from anybody. It can come from a peer. It could come from a letter that I read. It could come from a great investor I follow, and so
Okay,
on. It could come from a book that I read about an author who built a wonderful business, or who blew up a business, and he wrote about his the reasons and what he learned from that. So I keep collecting this kind of stuff, and I'm
and
bringing
then you
them.
keep upgrading it with that as you think. So okay. Now, before I forget this, and I'll come to investing related questions. How to access your courses? Is it only for Flame University or is
So
it?
that's another interesting thing that has happened. I was at MBI for more than 20 years. The problem with MDI courses was that it was an MBA program, and you have to be enrolled in the MBA program,
Hmm.
to do CAT and get into MBA and read a lot of
Hmm.
papers before you got a chance to
Hmm.
get into my class.
Hmm.
Now that constraint is gone. So
Okay.
it's now so Flame University has two parts to it. One is the university, which is an undergrad and postgrad programs where I can teach these papers in a different format. They're a longer period, this thing, or I can do workshops. So I do workshops in the other part of the university called the Flame Investment Lab, where a lot of practitioners come and teach. So it's just not me. There are many other wonderful practitioners and teachers of value
Okay.
investing who come to class over there, and they do this 3 year, 3 day, 4 day programs. And in those programs, anybody can come in. You
Okay.
don't have to be university student, and that becomes very interesting and interactive, and very enjoyable as well.
That's amazing to know. That's amazing to know. Now, I think I'll just go cash flow earnings, the point on value accumulating the companies. I mean, Professor Bakshi, you must have seen a trend, right? Companies, cash flows are not there, earnings are not there. Well, they're doing incredibly well. I mean, and it's a bit of a venture capitalist mindset I see coming into, a bit of Venn diagram. If you do, there is a, the thinking, existing thinking, the what you call the value investing thinking, and then you see the venture capitalist thinking coming. There's a bit of merger is happening there. Do you see that? And you excited about it, or?
I'm no, I'm see there. I don't want to pull down the VC industry. They are doing a lot of wonderful things by helping entrepreneurs visualize a business opportunity and backing them at an early stage, and then seeing many of them fail, but some will succeed. And it's always good to have that as part of the economic activity. That's very pro-social. It's very good for society, for civilization, and for some funds who pick the right winners initially. It's not my game though.
Okay.
I wish them well, and I'll watch it all from the sidelines. But I do have a deep interest in having companies come to market, do their IPOs, and have spent some time in the markets. So there is a track record of governance in public markets, and also the hype is gone because the IPO hype
Uh,
is not there after a few years. So
yeah.
for me, it's a very interesting area to look for opportunities. And by the way, this is very unique to India. If you look at other countries, especially in the developed world, you will see the number of companies that are listed are actually shrinking because they are going private or they get acquired. In India, the number of companies that are listed are actually increasing, and increasing very rapidly, because we have over the last 20, 25 years a very healthy, private equity and venture industry, and these guys have backed a lot of companies, and they will come to market. They may be hype at the time of their coming to market. They may get a very wonderful exit. There's a lot of gaming around IPOs. No problem about that for me. I don't participate in those games, but I do like the fact that there are more there 5 years from now there'll be many, many more companies in India listed than there right now. And 10 years there'll be even more. And that number, you can just look at the number of companies, and these are very good businesses. Some of them are very, very good businesses that have come to market. You may not like the valuation, you have no idea about the governance behavior because they just went public, but that's fine because they are here now. They're going to be here 5, 10, 20 years from now. So at some point you may find it very interesting to buy those businesses. So that's a very, very interesting landscape for me to look at. So
Okay.
but I don't. I mean, you asked about businesses which are, if there's a trend, or they don't make
Hmm.
money right now and all that. That's true. There's no doubt about it, and there are many such businesses which are wonderful for society. Like Zomato is a case in point, or Paytm is a case in point. They're like wonderful from society point of view. They create so many jobs. They make economy much more efficient. They also, I mean, they are very good for society, and they're very good for consumers. People who use these apps, they absolutely love these apps, right? That's why the user base keeps expanding time after time. So they are great from society's point of view. They are great from users' point of view. Whether they'll be great from the shareholders' point of view, that
Hmm.
remains to be seen.
Yeah.
And I don't have a view on that they will always be terrible businesses. Maybe at some point of time they become great businesses. It's too early to tell right now, but as of now, they are not something that attract me because they consume a lot of cash.
Yeah. I think I'll just again you talked about history, and I'll let me pick two companies, and these are not Indian companies because I think my focus has been Professor Bakshi for some reason more US. I pick Amazon and Tesla,
Mhm.
and I've seen you talking about Tesla before with Vivek on Vivek show or something. I don't know. I don't remember that. Now, did you expect them to come out with such successful investments?
I don't think anybody did,
Okay.
including the founders. In fact, Tesla founder Elon
Elon
Musk
Musk.
has gone on to say that the stock is overvalued at some point of time, and
Hmm.
he said we are almost dead.
Hmm.
You see only one in real. So one of the experiments I do in class is about thinking in terms of parallel universes. So
Okay.
you are seeing there are many we are seeing outcomes of living in one universe. In some other universe, Tesla may have not existed at all. It may have gone bust long ago, and Amazon might have too. So the confluence of many factors that have contributed to their success, including a lot of luck, plays out. Uh, so it's wrong to assume that because Amazon has succeeded, there will be other e-commerce companies will also. People keep talking about the next Amazon or the next Tesla. That's the wrong way of thinking about it,
Okay.
because you can't really know a lot about. So there's survivorship bias that is playing out. The factors that contribute to success may also have been there in other companies that blew up. So unless you look at the graveyard,
Mm-hmm.
you really don't know. So at the end of the day, Amazon
Hmm.
is an e-commerce company, and the typical e-commerce company future is not very bright. Tesla is an automobile company, and we all know how terrible that
Yeah.
business, overall. So by looking at exceptions, you can't draw conclusions about the probability of success in a given field. So you have to be aware of the graveyard out there.
Okay. Now that's fantastic. Look, this we talked about Warren Buffett, and I think he inspires a lot of people. The world owes a lot to that man, Professor Bakshi. What's your favorite thing? Do you have any favorite quotation? I know you talked about his letters, and you said that how to search those letters, and if you want a particular topic you want to search on, go and search that.
Yeah.
Now, what comes to your mind? What's the best quote or what's the best learning from him?
There's no such thing as best. It's like saying what is your favorite lesson from the Bhagavad Gita. There isn't any. I mean, the
Okay.
whole thing is worth reading. So, coming to the point, letters are very important. So, a lot of people read them sequentially, and that's good. There's nothing wrong in learning, how Buffett, what he wrote in 1980s
Mm,
and then 90s and then
mm,
later. But the thing is that he talks about the same topic over and over again throughout this journey of his career of more than 40 plus years. So why not pick out what he wrote on stock buybacks 30 years ago, 20 years ago, 10 years ago, and what he's saying about them right now, and put it out in a single document, print it out, and then forget everything else and think about how his views on buybacks have changed over time, and they have changed dramatically over time. So you will learn a lot about if you do this kind of a horizontal, analysis instead of just reading chronologically. So I like that a lot. I extract pieces, what he wrote on Scott Fetzer, what he wrote on Seas Candy, what he wrote on Rose Blumkin, Nebraska Furniture Mart, what he writes about the insurance business, what he writes about, even what he wrote about Wells Fargo over the years and how he went wrong about that, how he went wrong on IBM. So what he said and what really happened. It's important to take a topic and find out what he wrote about it then, what he thought about it then, and what really happened. More often than not, he's right, but it also gives you a sense that somebody who's such a spectacular track record and what an amazing human being he is, he's also been spectacularly wrong. So that tells you that they're only human, right? So they can make mistakes, and when you make mistakes, you don't have to blame yourself a lot. So everybody makes mistakes. This investing is a probabilistic game, but you have to lay out the reason why you're doing what you're doing, and he's done that, and he has whole sections on how I screwed up, mistakes that I made in the last 20 years and what I've learned from it. These are very important lessons, right, to pick up from a human being who's done so well in for his field. So I do, and the way he lives as a human being also an important lesson. There are parts of him which you may not like, many things like what is love for sugar, for example. Uh, but the fact is that he is a hell of a person and he's a hell of a teacher. So just pick what you like.
Now, I just want to take you a little bit back to your school again. And, a student, a very average student like me comes to you and say, Professor Bakshi, I want to invest. This is a company A I like. Uh, and, how should I make sure that this is the company I want to buy? What would you say? What would you say? Go look at this, look at that, make sure this.
I'll do that. I'll say, have you looked at this? Have you looked at that? And I'll say, why only A or B? I would expand I will give in another example to compare and contrast. Because typically people think that their choices are only limited to A versus B. But we have 4,000 companies out there. So we call this a decoy effect. If you put a decoy in there, people start comparing with the decoy, and the other things start looking very attractive. So if I put a $120 bottle of wine on the menu, and a $15 bottle of wine, and then I put a $75 bottle of wine, the $75 bottle of wine doesn't look that expensive anymore because it's being compared with the $120 bottle of wine. Where the $120 bottle of wine is a decoy, has been put there just to boost the sales of the $75 wine. So these are experiments that are clearly there. So one thing I would do with the student is to show them there are many other opportunities. Not just this one. And at the end of the day, you're in the capital allocation business. You're not in the automobile business. You're not in the cotton yarn business. You're not in the IT services business. So I would say just look at the numbers and look at the things that matter in fundamental valuation, and how do you look at this company versus the ones that you have picked, and that makes them force them to think about factors.
So I think, yeah, no, I think amazing. So capital allocation, let me pick on this. As an individual capital allocator, Professor Bakshi, should I be concentrated? Should I be, you know, 5, 10, 15? I know there is no
right
right.
answers here.
Yeah.
This is not physics where the answer will not change no matter where you ask it, as to how does the law of gravitation work on planet Earth. It's the same everywhere. It's not the same with these questions that you're asking about. One of my favorite lectures recently was the opposite of a good idea can also be a good idea. So you may have concentrated portfolios and do well, and you may have concentrated portfolios and blow up, and you may have diversified portfolios and you may do terrible. And you may have, you be like Walter Schloss or Ben Graham have huge stocks in your portfolio. So there are no real right answer, but you will find your answer by going through life and trying various things. So if you have to make mistakes, make them early in your career. Making big mistakes later on in your career makes it hard for you to learn from those mistakes and come back because you don't have time on your side. My recommendation is that if you want to be very, very concentrated, do it early on. See if it works. If it blows up in your face, you will learn. And by the way, if you even look at the most concentrated investors, Berkshire is considered to be run by people who believe in concentrated investing, but Berkshire Hathaway today is the most diversified conglomerate in the world. So watch what they do, not what they say, and also what they said made sense to them as youngsters may not make sense to them as where they are right now. So your own thinking on that subject will change over time. Once you have made a lot of money, you will become much more careful of protecting that capital instead of making capital. So moment you go from making money to protecting money, you shift from concentration to diversification. So it automatically happens. So there are no real right answer. It depends on the situation of the investor, the age of the investor, and what outcomes bring to that particular person by following a certain practice.
Amazing. Now, Wall Street estimates. Professor Bakshi, you have a view on that? Wall Street is estimates.
I do. So, if you talk about sell side research, I have views on sell side research. Some of the guys who do sell side research they're fantastic in terms of domain expertise, and but you just ignore all their tables and DCF, and ignore the price targets and the time by which the price target will happen, and focus on the fundamentals, or and ignore what they say about what happened in this quarter and what they estimate and what how they missed it and all that. Ignore all that. Focus on the industry economics that they bring to the table, because that's where the skill is. That's where you can learn a lot about a business from sell side analysts. So to the extent that I read report, yes, I do. Some of my students are fantastic sell side analysts, but I completely ignore their projections and the price targets.
So you're not in a prediction game at all. Like,
I am in the prediction game, but I don't want to predict as to by when what will happen. Obviously, if you are investing, you are always trying to predict that the future is going to be very bright, which is why you are buying into the business, right? Why would you buy into a business if you had no prediction? You have some view. You have to have some view, and you have to be very confident about that view. So to be sure, you are predicting, but you're predicting what will happen broadly and not when it will happen. I mean, by when, it doesn't mean that if it doesn't happen in 30 years, I'm okay. You're not. But you're not making predictions that the price of this stock will be so and so by such and such time. That is not what you do. Or interest rates will go down, or or inflation will be there, and next quarter. That's not what you do. You are in the prediction game, to be sure, but the things that you predict are very few. The 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 period over which you make those predictions are very broad and a little further out than what most predictors are doing in the marketplace.
I think a couple of more questions before I call it off, Mr. Bakshi. Structural changes, you said. I think in one of the interview you talked about that you learn from the structural changes. And I think a lot of people think it's sin money. Do you think crypto is a structural change? Blockchain is a structural change?
Absolutely, no question about it. It's an important technology. It's here. It is a huge, benefits in terms of security and decentralization and all of that. It's going to play out over the next 15, 20, 30 years. I don't know, but 100% certain that this is a structural change that is happening, and it will throw up a lot of opportunities and also present threats to many other businesses that are already there. It's just that I'm not competent to spot the winners or the losers, at least at this point in time.
Okay. And you talked about compounders, right? People were saying that people, uh, I remember that, people know how to compound the wealth, but they don't exactly understand what a compounder is, something like that. You had a view on that in one of the interviews.
Well, the word compounder comes from the word compound interest, and the compound interest people are very familiar with. It's if you compound your money at 18% versus 17.2%, then over a 30-year period, the terminal values will be vastly different. Everybody understands that, the mathematics. What is important in terms of compounder is compound interest inside a business. How does a
Hmm.
business compound its own capital? The operating assets and the earnings on those assets. How does that relationship play out? So to that extent, for me, compounder would mean a business that has the capability, maybe not now, maybe in a couple of years, to be able to earn a very large return on invested capital as compared to putting their money in a bond, for example, or in a debt fund. One. Number two, to have the ability to protect that compound rate, because you have some entry barriers, and there are many businesses which don't have that protection. They are only benefiting from temporary prosperity caused by a shortage which will not last, or they are niche which will become large and then there will be competition, or there are no real entry barriers over there. So the whole thing about entry barriers comes into play here. You need the return to be excellent. You want it to remain that. For that, you need entry barriers. And the third thing you need is the reinvestment opportunities, because without that, I do this experiment in class, a thought experiment. You have the street vendor outside your college. If you do the math, his ROCE is very, very high, because his capital investment is very small, and if his daily revenues are maybe small, but if you take annual revenues in relation to the money that is invested in the cycle and the utensils that he is making his vada pav in, his ROCE will run into thousands of percent per annum. But he is not a rich person because he doesn't have reinvestment opportunity. So you need high ROCE, you need protection of that high ROCE from competition and regulation and management mistakes and so many other enemies of high ROCE. And then you need a reinvestment opportunity. So there are these ingredients that you need. for it to become a compounder. By the way, there's a difference between compounder as a business versus compounder as an investment. So many businesses which are fantastic compounders are already recognized as such and have become so expensive that they may not turn out to be investment compounders. They are business compounders to be sure, but people have become over optimistic about their prospects and they have raised the price level to a point that a great business may not turn out to be a great investment. So it's important to make that distinction between a business compounder and an investment compounder.
Yeah, I think two more questions, Professor Bakshi. One is this, as an investor, there is evolution, right? It's a very intense journey, and sometimes you end up talking to yourself a lot more, right? I mean, that's what I feel, Professor Bakshi. Now, you were investor a long time ago. You're an investor now. What have you told yourself? Like how? What's the discussion you do with yourself on investing? And I hope I'm able to convey my question here.
Yeah, you have to be very humble about it, in the sense that no matter how hard you work in this field, you have to recognize it's a probabilistic field. A lot of people don't get this right. For example, if you are a cricketer, you may be very good, you may be Sachin Tendulkar, you will get bowled out, right, once in a while. You will, no matter how much you practice, no matter how hard you practice, you will not hit six on every shot that comes on you. So no matter how skillful you become, so you have to be able to distinguish between a good process and outcomes. You will get bad outcomes even the process is good. So when you have bad outcomes, you don't have to blame yourself for that. It's just you win some and you lose some and you move on. It's just bad luck, not bad discipline on your part. The process may be absolutely fine, but you have still have a bad outcome. A lot of people don't get this. They become very depressed and they start blaming themselves. They start looking for lessons when there aren't any. Just keep doing what you are doing. If you are going to hit 7 out of 10 or 6 out of 10, what matters is how those six do and what happens to those four, how quickly you can get out of them without losing a lot of money. The ones that don't work out. So that's one thing which you have to keep reminding yourself that, okay, I had a bad outcome. Is it the consequence of a bad process or is it just a probabilistic, bad luck situation that has arisen? It's not easy to make that distinction, unfortunately, in our field. The feedback is delayed. So, if you're doing archery or shooting or, playing, even doing day trading, whether you're good or bad, you get to know very, very quickly, right? But it's not the case in investing. So this whole thing of distinguishing between skill and luck is very, very tough, and you are always obviously attached to the outcomes. So you start blaming, even though it's a process that was at fault, you start thinking that no, no, process is okay. I don't have to change that. So it's hard.
It's hard. And I think that's the difficult part. That's the most difficult part, at least I find for myself, Professor Bakshi. Now, spirituality, Professor Bakshi, it seems a lot, on your mind. I think Bhagavad Gita you talked about. How does it work? I mean, you were interested in Warren Buffett letters, and you talked about the multidisciplinary approach in investment. Is that playing out here? How did it
Not
start?
really. See, what has happened, I mean, of course, there are a lot of spiritual um, thought out there. Indian spiritual thought is so well known, it has influenced civilization for more than 5,000 years. Um, we have Stoic philosophers, we have all kinds of philosophers out there, spiritual philosophers out there. What I've been able to figure out, and I'm still early in the game, is that there are a lot of similarities between what we teach in behavioral finance and economics and spiritual thought. For example, when you talk about loss aversion, we talk about that you have to treat losses and gains equivalently, which is not what most people do, but you should do that, right? If you talk about, but the same idea is already there in spiritual thought. We call it equanimity. It is there in Dhammapada in Buddhism. It is there in Hindu, spiritual thought. It's there in so many cultures out there. Equanimity, it just be balanced. You will have pain and pleasure, and you should treat them just the same. So it's there. You talk about commitment bias. We call it commitment bias. I'm committed to it, or we call it endowment effect. But we have had the idea of detachment going back, such a long time. We know about the power of detachment, how not to get emotionally attached to something. So basically the point is that the more I think about it, you talk about the idea of moats eroding over time. or mean reversion, it reminds you of the spiritual idea of impermanence, that there is nothing permanent here. Everything will change. So, you start connecting these dots, so we have impermanence, equanimity, detachment. There are all these wonderful ideas that are very old ideas and have lasted such a long time, which are being sort of converted into new ideas. So I call it as a, old wine in a new bottle, and we call it behavioral finance.
I think on that note, Professor Bakshi, I'll say thank you to you. And it's a noble idea we discussed. It can go on for hours. I have so many questions, but hopefully sometime I meet you in person and come to university as a student and
You're most
for
welcome.
3 days.
Yeah.
And
Thank you, and all the best to you.
Thank
Thanks
you
a
so
lot.
much. Thank
Thank
you.
you.
Bye.